Good afternoon and welcome to another VSA Capital Technology and Transitional Energy podcast with myself, Phil Smith at VSA Capital, and Andrew Monk is away today on business. So I'm delighted to welcome onto our podcast Peter Matson, who's head of our private equity practice. Good afternoon to you, Peter.
Good afternoon, Phil. How are you today?
Very well, thank you very much. And just looking through the news, Peter, I can see that it's been pretty busy on the markets.
It's been a volatile week, and I thought we start to look at the other side of the pond in the US. There's been quite a bit of news flow and a lot of volatility. And beginning of the week on Tuesday, we saw one of the biggest one-day falls since 2020 on the Dow Jones. It dropped about 800 points, and Nasdaq dropped about 4%, which was a huge move. And it's now actually the Nasdaq, it's 22% off its high, and it posted a 52-week low on Tuesday. And this comes after Federal Reserve Chairman Jerome Powell indicated last Friday that there will likely be an aggressive interest rate hikes next month. So the Russia-Ukraine war continues. Investors are monitoring the potential economic ramifications of disruptions in the global supply of energy. So the rate increases that the Fed is expected to do are meant to quell the runaway inflation. But of course, investors are more worried that an interest rate spike will slow consumer spending and the housing market. So we also saw the down move in the Asian markets, where they're also worrying about the shutdowns in China, of course, which is triggered by the zero COVID policies. And China, of course, being a big customer in the US tech and semiconductor space. So fast-growing tech stocks are really very closely linked to the decisions from the Fed. Their rates, very interest rate sensitive companies that have a high price to earnings ratios because they're typically valued on future profits and pay no dividends. So higher rates typically mean that future earnings will be worth less than they are today. Saying that, a lot of the earnings that has come out of the S&P 500 have actually topped analyst expectations. So about 81% of the companies have exceeded earnings expectations, with first quarter profits now expected to have climbed 8% from a year ago, up from an estimated 6%. So they're beating estimates. But you have this sort of, it's a bit of an irony. And I read one analyst from Investec saying, ironically, the better the corporate earnings backdrop, the less recession risk there is. So the Fed can increase rates more aggressively, but the implications that will have on valuations is a question mark, isn't it? So paradoxically, good corporate news could ultimately be bad news for the market. What do you make out of that, Phil?
Yeah, it's really interesting. Well, of course it's interesting, and it's very important for us investors. And a lot of the SIP funds and global funds that are in SIPs have got a high proportion of the bigger tech companies is in, but you have to look at the information, I think, really carefully, because we've got such an unusual mix of circumstances now in terms of the supply chains, what's happening in Europe with the war and energy costs. There's all sorts of factors in there, Peter, to be watching, but the Fed has already kind of pre-warned on what it's going to do with give an indication on interest rates, but it is going to be what happens over the next few months, I think, with the pace of interest rate rises that we need to watch carefully. And also something else, Peter, we've been watching out or talking about a lot in the podcast is what is happening to end demand, because these quarterly results coming through the US are really well timed. And obviously they're talking about what's happened in the last 3 months, but investors are listening out to what they're saying on their outlook as well. And we've seen some interesting outlooks coming through. So
yeah, absolutely. And also perhaps we should be cautious in reading too much into it, but we also saw a number released today from the States, which was the GDP numbers for the first quarter, showing that the US economy actually shrank 1.4%. They were expected to rise with about 1%. It's a complex situation, isn't it, Phil?
Yeah, I mean, with GDP figures, again, you've got to look more deeply into that as well. I'm sure I quickly saw a report about the trade, the trade deficit, but and they're saying, pointing out, well, hang on a minute, there's a lot of it, inventory building is going on because, of concern over supply chains, and you've got to remember that China's a huge manufacturing country and supplying the states, and if people think that there's going to be more pressure on the supply chains, they'll build inventory. So again, you've got to look very, very closely at the data and look at the outlooks and what these big corporations are saying that their customers are doing. And are we looking towards a recession or not? I mean, I thought, did you might have seen the results from Alphabet, which is it's the Google parent. They had their quarterly results, and Google's share price has been doing really, really well. I mean, it's doubled over 12 months, but year to date is down 20%. And they apparently reported their first quarterly revenue miss. And saying that the war in Ukraine has impacted YouTube ad sales.
Mm-hmm.
But you've got to remember, Google itself, in terms of advertising, is sort of in the high 20% of the advertising market. It has an enormous share of the advertising market, particularly online. It's a big share of the online advertising market, and advertising itself can be quite sensitive to economic performance. So we've got to see what kind of happens there. But it was interesting to see what Google were actually was saying was happening in those markets. Also, Microsoft always is in a lot of portfolios, a lot of global fund portfolios for good reason. I mean, Microsoft's price, Peter, was up 3 times in the last 5 years. 3% in the last 12 months, so it's down 16% year to date. But they reported their quarterly earnings, and they made. I mean, the figures always beg a belief in terms of scale. They made a profit of 16.7 billion on revenue of $49 billion in the first 3 months. But the profit was up 8%, and the revenues were up 18%. But Microsoft, and this is really, really interesting, I thought was the pace of growth in their cloud services, cloud platform. And a couple of them is Azure, and Azure saw 46% growth. Now, this is a whole structural shift of business, moving more and more services into the cloud, and of course, you and I are using a lot more services from home. But this is primarily business investment here that's driving that, and that's an indicator ahead. And I think that Microsoft had quite a positive outlook as well. Here we go. They were forecasting double-digit revenue growth in the next fiscal year, driven by cloud computing, and that's business investment. So that's a kind of, do you know what I mean? That's a positive indicator from one of the biggest tech companies in the world. And also, Samsung reported today, and Samsung, of course, we all know them from their mobile phones, TV screens and everything, but Samsung is a very big silicon chip manufacturer, one of the biggest in the world. And they make memory chips that go into computers and servers in data centers. And they were saying that their operating profits were up 51%. And a lot of that was driven by record high quarterly sales into the server market from its memory chip business.
Mm-hmm.
So again, being driven by cloud, and the cloud being driven by structural investment by businesses, but also by us, of course, using more of the cloud.
Yeah. The cloud is it, isn't it?
Yeah. Oh yeah, absolutely. And also, and again, it's not tech related, but again, sort of economic activity related, were Caterpillar. have just reported.
Yeah.
You know, of course, well known for their earth-moving equipment, but they were seeing strong demand from mining in particular, for minerals, in oil and gas markets. Obviously, warning on inflationary costs, which are, you know, uppermost everyone's mind, and they were, you know, passing on price rises as well, as I think everyone is at the moment. But so it's kind of watching really, really closely what these businesses are saying about their outlooks, and looking out for changes in, of course, consumer behaviour, because they're, you know, the consumer is a big component of the US economy, as it is with our economy. So you can see the market sort of moving around at the moment and trying to make what they
are,
can.
And we also saw last night the results from Facebook, or Meta, as it's called now. Although the profits was about 20% down on the year, but they showed 7.5 billion for the January-March quarter, which beat all the analysts' expectations, and the result, the market actually bounced back up on the back of that. So it is really interesting to watch these tech stocks and how well they actually perform.
Yeah, I have to say, they are proving to be surprising. Maybe surprising is the wrong word, but they are proving to be resilient. And you know, a lot of. I was just going to say, it seems to be reflecting business spend and business investment ahead.
Yeah, no, absolutely. Now, Phil, what's going on here closer to us in Britain?
Yeah, okay. Well, so we've had we've had a number of trading updates. There's not been much news, to be honest, this week in terms of actual trading updates, but we had a trading update from, well, again, it's cloud services related. It's Red-Centric. The ticker is RCN. The market cap's 193 million market cap, cloud services business, and they provide things like hybrid cloud services, network connectivity, security, you know, to businesses. And their expectation is for revenues, they're saying this full year 22, revenues are 93 million, up from 91 million, and adjusted earnings of 11.5 million versus 11.1 million. So it's sort of, you know, for them, this looks like sort of steady progress. They did note, got to remember, cloud services, data centers use a lot of electricity. They, of course, have seen their electricity prices increase. That's added $500,000 to costs. But I think important for Red-Centric, I mean, they've made a lot of investment in their platform and in their networks, is that they've agreed a new 4-year bank facility, which gives them 80 million of funds available, and further 20 million facility. So gives them plenty of scope to expand their business and acquire and do whatever. So that was Red-Centric. One that I think provides a kind of wider picture of what's going on is Spectris, and this is one picture we have mentioned. We have mentioned a number of times on the podcast. Spectris, the ticker is SXS. The market cap is £3 billion, and Spectris is it's primarily an instrumentation company, test equipment company. So if you look at what it does, on a divisional basis, Spectris has a division called Malvern, and it's Panalistic is one of its best known brands, and it does X-ray analysis equipment, spectrometers, chromatography equipment, and this sort of equipment is used in developing all sorts of materials in laboratories. It's for measuring chemical. It does particle analyzers for chemicals. It helps companies develop vaccines, vitamins. You know, this is highly specialized measuring equipment. And they were saying that the Panalistical division of the business, and also X-ray equipment for looking at minerals, they had seen strong demand from pharmaceuticals companies, from metals and mining. So this is a trading update that they were providing for the 3 months to March. So
very impressive.
And they were saying that, you know, looking to group, the like-for-like sales were up 12%, and the order books were 29% higher. That's for that division, which is seeing strong demand from pharmaceuticals and from mining. but also the HBK division, which has instrumentation that measures torque, noise, vibration, pressure, all the sorts of things that you'll be measuring if you are developing a new model of car or developing aircraft. You've got lots of rotating parts, you have noise, vibration, you have pressure from systems. So their kit instrumentation is used by the automotive sector, by the aerospace sector. And they had seen positive demand, particularly from automotive returning to growth. Now, remember, this is equipment now, and this is companies buying equipment. And companies only buy equipment if they're confident ahead in terms of what they are doing. And Industrial Solutions division, again, that's what's running on from pharmaceuticals and semiconductor companies, customers in Asia. So capital spend and clearly benefiting from that being sustained. So I thought that was an interesting statement from Spectris. The company's recently sold off a division, which Andrew and we commented on in a prior podcast. It sold that for £400 million. So it now has it's got a pretty healthy balance sheet, and it's announced a £300 million share buyback as well today. So
that should be supporting.
Yeah, absolutely. So an interesting update from them, but again, a good company to watch as well for what it's seeing in its end markets, because it's serving end markets globally and it's serving end markets across industries, and it's it's capital spend for its customers. So it's what its customers are doing there. So that was an interesting trading update, and another one, but on the smaller one that we've been following for some time. I think actually Andrew has this PA in his holding, so we need to point that out to investors. Is Nexus Infrastructure. The ticker is NEXS. It's a 90 million market cap company. They had a trading update for the 6 months to March of this year, and Nexus. We'll just quickly say what their expectation is in terms of their revenue. They're expecting revenues of £80 million. For the 6 month period, up from £64 million. Good growth in revenue, and their order books are at £307 million, and they're up 2%, but 6.6% since September. So it looks like they're seeing order books accelerating there. This company, what does it do? It has 3 divisions. It has Tamdown, and it's a civil engineering business, and they provide a lot of infrastructure services to the house building sectors and commercial sectors. So that's things like earthworks around sites, building highways, basements, drainage, all the sort of systems you need on a big construction site. And that division saw its first half turnover up 26%. TriConnex, which connects utilities and services to new residential businesses. Obviously, building houses, you need to connect gas, electricity, fiber networks. That's all sales up 2.5%. And the division that we've talked about a lot is eSmart Networks. And this is its electric vehicle charging business and infrastructure business. So they actually develop electrical charging infrastructure. So they develop it, they go into a big commercial partner and they lay out what sort of infrastructure is going to be needed so that they can put in charging stations. And of course, the one thing we need in this country is charging infrastructure for electric vehicles, be they commercial or be they owned by individuals. This business is growing rapidly, so its revenue up 200% year on year. And they have said they're investing in it, so profit's going to be second half weighted, loss making first half, but it's a rapidly growing business, and their order books, they are saying during a 6 month period, were up 55%. So good trading update, I thought, there from Nexus Infrastructure.
Very, very, very good. And by the way, going into, and I think you're going to talk about some transitional energy and battery tech on the private side, on the venture capital and private equity markets. I read an article this week that climate tech is now the fastest growing vertical in Europe. And funding for last year was 11 billion in Europe in 2021.
Yeah,
having been 1 billion in 2017. There's now the only thing that leads it is fintech still, but climate tech is a close second which is really, really interesting. And of course, UK is very much involved in the space with around 20% of that market. And I think on the battery tech side specifically, Phil, what's going on there?
Yeah, we saw again reflecting sort of growth and investment. This is a report from a company called Mercom Capital, and they pointed out some of the figures in terms of battery storage investment. And they were saying that they quoted some figures here. Battery storage companies raised $70 billion for the whole of last year. I think this is US, and that was up from 8.1 billion. But in the first quarter of this year alone, have raised 13 billion already. So, dramatic increase in investment, and kind of, what we talk about it a lot, the transitional energy and talking about battery technology, but it is the scale of growth now in this sector and it may be, it's small beer in relative terms when you look at the size of the overall global infrastructure markets, but you can see how quickly this is now accelerating.
This is good news, though, in a way, isn't it? Because all the worries that were there in the first quarter, whether it was the COVID or the Russia-Ukraine situation, inflation fears, you still see a good deal flow in that space and a lot of funding.
Yeah. You do, and this is why we're kind of, with all of this bad news, is trying to look through it and see where businesses and investors are looking ahead and what they're looking to and what the money is going into, because it's very easy to kind of get overwhelmed by all the doom and gloom headlines, but you've got to see through that and see ahead. And ultimately, for investors, they are investing for their on the long term.
Absolutely.
And for pensions, and on keeping on the theme of battery tech and investment. And here's one way of investing in energy storage is the UK quoted Gore Street Energy Storage Fund. The ticker for this is GSF. The market cap is about £560 million, and they're UK based investment company, and their primary activity is to invest in utility scale storage, and primarily in projects located in the UK and the Republic of Ireland. Now, there was a recent interview that I was reading with their CEO in Energy Storage News, and he had some pretty interesting comments to make. I mean, he's saying, Gore Street's market share of operational storage in the UK is about 12% of projects, and he was saying that they, in terms of the way they make revenues, 50% of it is from energy trading. So, obviously switching the batteries on and supplying energy into the grid when prices are peaking within the day, and also grid balancing. So that's providing energy from the batteries when the grid is, the wind turbines, whatever, solar generation just falls off momentarily, and they kick in the batteries to make up the shortfall, and obviously they get paid for their balancing services. But Gore Street, the shares have performed very, very well in the fund. Also of note here is that they did a placing in April, and I was reading about the placing, and they were targeting raising 75 million, and they had to increase it to 150 million because of institutional, because of investor demand, and they're using their proceeds for their pipeline of investments, and they've got a 1.3 gigawatt pipeline of investments. 900 megawatts is in the UK, 375 megawatts is in North America, and 100 megawatts in Europe. But in this interview that I was reading with the CEO, he was saying that they are now seriously looking at Germany. In terms of market opportunity. And of course, we know that they're going to be investing more in renewable energy. So I thought that was So that's just repeat. So that's Gore Street.
Very interesting, Phil.
Yeah, the Gore Street Energy Storage Fund, GSF is the ticker. And I guess finally want to wrap up on transitional energy that I did spot was Sensata. Ticker is ST. I think it's New York Stock Exchange quoted. It's $7 billion market cap. They're a huge manufacturer and developer of sensors that are used in the automotive, industrial, and aerospace units. And these are electronic sensors, and they used to sense things like temperature, pressure, torque, all sorts of things that are happening in vehicles. And they also have technology for, I think they do inverters for electric vehicles and electrification as well, and converters. So these are things that are used for like taking the battery DC, converting it to AC. So you do that anyway. And ever moving on and looking to the future, they've acquired a company called Dynapower for $580 million, and they make they have inverter and converter technology and rectifiers. So they're expanding their portfolio. Sensata into renewable energy generation and electric vehicle charging, which we were talking about earlier. So, like I say, all the bad news isn't stopping companies moving ahead and looking to the future. So that was very interesting. So there we go. And as Andrew says, we're approaching the end of our allocated time, Peter. And so it's been a pleasure having you on. Sorry, Peter?
Thanks for having me on, I said.
Well, it's been an absolute pleasure. And as we do always end our podcasts, if our listeners have got any ideas about companies that we should be taking a look at, that would like us to talk about, or anything else related on the tech and transitional energy sector, we would be delighted to hear from you.
Absolutely. Thanks, Phil.
Thank you, Peter. That's it.